Welcome back to the International Wealth Builders Radio Talk Show. I am your host, Michelle Estelle, the home buyer coach here on KCAA, 1050 AM and 106.5 FM. Thank you for joining us again. And I just want to let you know that this show is for advertisement and informational purposes only. There is no commitment to lend. We aren't talking about loan programs or interest rates for specific programs. We are just educating you on different components of lending and different things that you might have questions regarding and that I get questions on quite often in my industry. So today in this last segment, we are going to talk about what drives mortgage rates. We're going to talk about 6 main factors that affect home loan rates. And obviously they are in a wide variety of things that you might not think are going to be a direct relationship to interest rates. And there's going to be some things that you always thought were a direct relationship to interest rates that aren't necessarily the only thing that affects them. So there are many, many things on a daily basis, weekly basis, monthly basis that will drive where interest rates go, whether they up or down. So the 6 components that we're going to talk about are economic data, geopolitical issues or geopolitics, inflationary pressure on the economy, the Federal Reserve, whatever they talk about, whatever they say, whatever their announcements are, and the stock market and global events. So these are the 6 main factors that drive interest rates. And within the 6, there's going to be things that come out in the news in these categories that will make rates go up and things that will potentially ease or have rates go down. So basically under the first category of economic data, generally speaking, there's something called expectation. If something is higher than expected or worse than expected, better than expected, worse than expected, can have an effect on the market because generally speaking, investors are already trying to predict what the news is going to be. So if they think the news is going to be better, or they think the news is going to be worse, or they think the news is going to be better, but then it turns out worse. So if it's not what's expected, it can negatively impact or positively impact where the rates go based on that data. And so as an example, rates going up might be non-farm payroll is higher than expected, or unemployment rates go down, or better than expected economic data overall. That could make your rates go up because something's better than expected, the interest rates could go up. When we generally have more unexpected news or negative impact on the news might be job data is stagnant or declining, or manufacturing is stagnant or slowing, or the housing market is weaker than expected. This could make the interest rates go down. So under that economic data, a key thing is better than expected or worse than expected. As far as geopolitics, this could be other nations or other countries' economies. So for instance, if China's GDP improves, interest rates could go up. If there's tension between countries, or we often look at the tension in the Middle East, if there's tension in some of these global areas or countries, that could affect the interest rates. So interest rates could go up if there's tension. In the same geopolitics, if a different country's economy is going down versus up, maybe our interest rates will go down as well. And if there's additional conflicts or terror type of events that are happening, then interest rates could go down. As far as inflationary pressure, what could make the rates go up with regard to inflationary pressure is high consumer price index, high wholesale prices, or higher earnings, hourly earnings. And then what might make the interest rates go down in inflationary pressure is lower consumer price, lower wholesale prices, and hourly earnings are lower. That could make interest rates go down as well. Now, as far as the Federal Reserve, this is often misunderstood because you hear on the news that the feds raised the interest rate to 0.5%. And oftentimes people think that that is the mortgage interest rates. Even though all markets are affected by things that happen in the Federal Reserve, they aren't raising a long-term rate. They're not raising the 30-year mortgage rate. They're raising a very short-term rate, which is the overnight rate that's charged to the banks, or the banks are charged each other for borrowing the money. So when the Federal Reserve speaks, it does affect our economy greatly. It also affects stocks and bonds, and it's really impossible to accurately predict what's going to happen to short-term rates. But if they're adding cash into the monetary system or creating a looser credit environment in an attempt to stimulate the economy, then rates could go down. And as far as the stock market, it's kind of goes in the same vector. So stock market is on the rise, then interest rates might be going up as well. And if stock market is in a decline, interest rates might be going down. And then as far as global events, when we have not too many global events happening, like very, calm weather or no catastrophic weather or events, then interest rates might be going up. But if we have any hurricanes, typhoons, tsunamis, or earthquakes, large events that happen globally, then interest rates could go down. So you can see that kind of the overall theme is when things aren't good, rates are lower. And when economy is stronger, rates can generally push up a little bit. So these are layers of things that affect the interest rate. So that's why they're moving and sometimes volatile. If we have some uncertainty in any of these areas, it can create upward or downward movement in the market. But uncertainty or better than expected versus worse than expected are a good indication of movement or volatility in the interest rates. So that is my final segment. I hope you learned a lot today regarding property taxes, adjustable rate mortgages, impound account, and what drives interest rates. And I thank you for joining me, and I hope to see you next month.